Welcome to the series of Those Damn Terms, in which we discuss one financial term in the simplest possible manner, that too in 5 minutes. Today's term of discussion is PEG ratio. PEG ratio stands for PE to growth ratio. If you would like to know what PE ratio is, click here. PEG ratio is a comparison between the PE ratio of the company to its expected rate of growth. Growth rate of what? The earnings. Let's take an example. The PE ratio of company A is 10. This means for every rupee of the earnings the company is generating, you are willing to pay 10 rupees. That is, if you want to buy this stock. Analysts forecast that the earnings of the company will grow at 10% for the next year. That means, if you want to buy this stock, you are willing to pay 10 rupees for each rupee of the company's earnings and for an expected 10% growth of its earnings. How much are you willing to pay for an expected growth of 1%? The answer is 1 rupee. This means we are just trying to calculate the price we are willing to pay for 1 rupee of the company's earnings with a 1% expected growth in its earnings. Hence, PEG is nothing but the PE ratio of the stock divided by the growth rate of its earnings. Here in this case, PEG is 10 divided by 10, that is 1. Let's go to company B. The PE ratio of company B is 20. That means for every rupee of the earnings the company is generating, you are willing to pay 20 rupees. That is, if you want to buy 1 unit of this stock. Analysts forecast that the earnings of the company will grow at 40% for the next year. You are willing to pay 20 rupees for 40% growth. How much are you willing to pay for 1% growth? 20 divided by 40, that is 0.5. PEG ratio here is PE divided by growth rate, that is 20 divided by 40. Usually, if we have to choose between these two companies based on PE ratio, we may choose company A because it looks inexpensive. But PEG ratio takes us a step further and tells us that we need to choose the company with a lower PEG ratio because it has greater growth potential. In essence, PEG ratio tells the price you may be willing to pay for a string of earnings you are going to derive in future. Usually, if the PEG ratio is more than 1, it means the stock is overvalued. If the PEG is less than 1, the stock is undervalued. And equal to 1 means it's at a fair price. Is PEG ratio the cure to all the problems of stock picking? In fact, no single ratio is. Many financial ratios should work in conjunction to help you make a better decision. PEG ratio, also like PE ratio, has its own limitations, so use it with caution. PEG ratio does nothing to give us a picture of the dividend yield. PEG ratio doesn't give you any picture of the cash flows or the debt situation of the company. The earnings growth rates estimated by analysts are usually confusing and misleading too. In fact, who can make a guess about future? It is not suitable for large companies like blue chip companies. Why? Because such companies may have reached a stage of saturation that there is no scope for future growth. The earning growth rates are smaller. PE ratios of such companies are usually on the higher side because they are large blue chip stocks which are always on demand and the stock prices are always high, but the growth rate is low.